We will be having about 4 speakers today. And this seminar is specifically for our mentees. And the purpose of the seminar is to have them present their research, get some feedback for improving their work, and most importantly, practice presenting their research ideas and answering questions about their research papers to prepare them for the PhD admissions interviews that they will be participating in starting from February. Our speakers for today will be Abdulmuttalib Salako, Bukra El-Rabani, Mohadesi Safshekan, and Chika Odinaka Iwuagu. So let me give a brief introduction of each of these speakers. Abdulmuttalib Salako joined us in 2020 as an RA and completed the BT certificate program in math in 2021. He is currently a master's student at Western Michigan University. He had his undergraduate degree at the Crescent University in Nigeria, in Abeokuta, where he studied economics and operations research. He is Nigerian. And then Bukra El-Rabani attended the African Institute for Mathematical Sciences. This is one of the top math institutes in Africa. And she studied a master's in mathematics. She completed a bachelor's in science and a master's in science degree in engineering, logistics and transportation engineering from Hassan I University in Morocco. She joined our certificate program in 2021, and she has successfully completed the certificate in economic theory, econometrics, and mathematical economics. She is from Morocco. And then the third person is Mohadesi Safshekan. The short form of Mohadesi is Martin. I think she likes to go by Martin. So if you people want to speak to her or ask her a question, you can say Martin. Mohadesi can be a big tongue twister that is difficult to pronounce sometimes. So she completed our certificate program last year. And before joining us here at Baum Tenpers Institute, she had an extensive research career at several development institutions in Iran. And she completed a master's degree in development economics from Al-Metabataba University in Iran and a bachelor's degree in theoretical economics from the University of Mazandaran, also in Iran. She is Iranian. And then finally, we have Chika Odinaka Iwuagu. Chika Odinaka Iwuagu is a fixed income dealer, bond trader at Zenith Bank. She attended the University of Nigeria, Nsukka, where she earned a bachelor's degree in economics. She is currently enrolled in our certificate program in economic theory, econometrics, and mathematical economics. And she is currently taking our foundational courses in mathematics, the one that is currently being taught by Professor Fadikwe. So now that we have learned a bit about our speakers for today, we will now begin the presentation itself. And our first speaker for the presentation will be Abdulmuttalib Salako, who will be presenting a paper on a new testable theory on deviations from covered interest rate parity. So the door is open to you, Salako. You can come in and then you can start your presentation. Thank you.
Good day, everyone.
Hello.
Okay, all right. I'll share my screen. I'm trying to share my screen, sorry. Can you share my screen?
Yes, we can see your screen, please.
Okay, thank you. Good day, everyone. My name is Abdulmuttalib Salako, and I fondly call Salako here at BT, which I often prefer. Today, I'll be presenting a paper on new testable theory on deviations from covered interest parity, a work which was supervised by Dr. Kumla Abutse, whose immense support during the course of this project is deeply appreciated. The outline of the project goes thus. We have the introduction, motivation, a theoretical framework, empirical results, conclusion, and a small portion of policy implication, and we have direction for future research. To the presentation proper, the CIP theory is, one of the most popular theories in international finance, and it represents the no arbitrage condition. What this implies is that if I try to invest in my country, say Nigeria, and I get a return on investment of a certain amount, and I try to, invest that same amount that I invested in Nigeria in another country and engage in a cross-currency swap transaction at an agreed forward rate, the returns that I'll be getting from this transaction, if it is converted back to my domestic currency, which is Naira, the returns will be the same. So there is no difference whether I invest in my country or I invest in another country. What I'll be getting at the end of the day will be the same. So this idea of covered interest parity held prior to the global financial crisis, 2008, 2009. But shortly after, there were not that this theory hasn't had a brief breakdown prior to the global financial crisis, but the deviations from this particular theory were very little, and there were quick convergence back to the equilibrium state. But after the global financial crisis, continued deviation from this theory persisted, and there were no chance for it to converge back to equilibrium. And this has caused several concerns for the global financial market participants and led to several, contention about the factors that could be responsible for these continued deviations from covered interest parity theory. The motivation for this paper stems from the intuition that the macroeconomic variables and credit spread could be potential drivers of covered interest parity deviations. And why macroeconomic variables? Macro variables tends to show the performance of the economy as a whole, economic growth, inflation rates, interest rates, exchange rates, and things like that. But in this paper, I focus only on two major macro trends, which is economic growth or economic performance and inflation. Since this is a good factor that could help a rational agent who tends to invest in a country make good investment decisions against a certain future or strategize against a certain future, it is important to consider this as a potential driver of covered interest parity deviation. And for credit spread, this also stems from the idea that if I intend to invest in a country, I must consider the returns that I'll be making. If the returns on investments in a country is low, right, that is the spread I'll be paying in addition to the benchmark rate of that country, right, that an investor or the agent will be getting on the benchmark rate of interest rates in that country. If it is higher, then that investment looks attractive. But if it is not, it looks unattractive. And investment in such security, debt security, or investment generally would not be given consideration. And as a result, this could also be another potential driver of covered interest parity deviations. There are many studies in literature, many extant studies in literature that have presented some facts about the deviations from covered interest parity. As I said, there were mild presence of CIP deviations before the global financial crisis. And these factors have been attributed to transaction costs, credit risk, and factors like that. But after the CIP after the global financial crisis, the transaction cost actually still remains. However, it is unable to explain away the deviations from covered interest price, because despite the presence of transaction costs, there is still continued deviation from covered interest price. Therefore, new perspective as to how to determine the factors responsible for deviations from covered interest parity were established. And factors that have emanated from research are credit risk, urgent demand and supply. Another one is the increasing cost of banks' balance sheet and regulatory requirements. These are factors related to macroprudential policies. And more recently, researchers have tended to focus on macroeconomic determinants and intermediary constraints, which is also something this paper tries to work on, particularly the macroeconomic determinants and a financial market variable. The theoretical framework that underpins this paper considers a rational agent that tries to invest in two classes of debt security. The first one being a local debt security, and the second being a foreign debt security. And of course, the local debt security is denominated in the local currency, while the foreign debt security is denominated in the US dollar. The local currency that we consider here is euro, and the foreign currency that is considered here is US dollars. So the US is the foreign economy, and the Eurozone is the domestic economy. The agent tries to choose a mix of consumption and bond holdings that maximizes lifetime utility. C represents consumption, and a beta is the standard discount factor that is ranging between 0 and 1. Here we have the budget constraints. We have the total use of resources, and we have the total source of resources to the right side. The idea here is that at the beginning of the period, the agent invests in a bond, in a domestic bond, BTL, raised to power L, and the interest rate is IT minus 1, and the spread that is being paid in addition to the benchmark rates, this interest rate is the SPLT minus 1. For the foreign debt security, this is the bond, the corporate bond, and this I star T minus 1 is the interest rate, while SPI T minus 1 is the spread that is paid in addition to the benchmark rate in the foreign economy. However, as we said, the agent engages in a cross-currency swap transaction where the foreign bond that is denominated in foreign currency is converted back to the domestic currency at an agreed forward rate F. Additionally, we have the output, and also we define G to be total output gains from technology shocks. And the idea here is that in addition to the economic performance, we assume that there's a technology shock that affects output, that increases the output from the original states. And this total output gains from technology shock is defined as follows. Here we have the technology shock for the domestic economy, which is a function of real bond holdings, and the foreign technology shock is also a function of the foreign real bonds holdings, although again this is converted to the domestic currency. due to the engagement in the cross-currency swap transaction. Here we define the value function for the Bellman equation, and the main theoretical proposition, which is the optimality condition that emanates after solving this model, is as follows, where XCCYT represent the cross-currency basis swap spread, which is this basis that is associated with the hedging strategy in the cross-currency swap market. Here we have the economic performance differential, and this is the credit spread differential, and this is the expected inflation differential. Accordingly, there are theoretical predictions that are, followed by the model that was derived in this paper. First, for the credit spread. For credit spread, the idea is that when the credit spread in the domestic economy is lower, it means that the investment or the bond, the corporate bond in the domestic economy becomes unattractive to the foreign agent who intends to invest in that country. And as a result, there is a shortage of supply of the foreign currency, which is the US dollar in this case, in the cross-currency swap market. And as a result, the shortage of dollar increases the cross-currency basis, which leads to more negative basis and further widens the covered interest parity. For inflation reflects the current state of pricing in the economy. For an investor who intends to, for a US investor who intends to invest in the Eurozone and realizes that the inflation in the Eurozone is higher, this gives him the thought that the expected value of the bond portfolio will decline if he eventually invests in the Eurozone, and as a result, the investment or the corporate bond in the Eurozone becomes unattractive to the US agents. This causes a reduction of US dollar in the cross-currency swap market, and as a result, the cross-currency basis widens, which of course makes the covered interest parity diverge further. Lastly, for the economic performance, if the economic performance is positive, this is a good outlook for a rational agent who intends to invest in the Eurozone. As a result, the investment opportunity or the corporate bond in the Eurozone becomes attractive to the foreign agent, and this increases the supply of the US dollar because the trading will be carried out in US dollars, right? This increases the supply of the US dollars in the cross-currency swap market, and as a result, the CIP shrinks and the basis associated with the hedging strategy in the cross-currency swap market converges. So these are the three main theoretical predictions that emanate from the model that we that was solved in this particular paper. And this explains the signs that are attributed to each of the parameters in this model. The data was for credit spread for both the Eurozone and the United States came from Bloomberg, and the others, the basis, inflation, and the industrial production index, which is a proxy for economic performance, also came from Bloomberg. The descriptive statistics shows that on average, the basis swap is negative for all the tenor was considered in this paper, and this shows that the basis CIP deviation is pronounced across all these maturity that is considered in this paper. However, the 10-year tenor is the most favorable because for the EU investors, this means that the covered interest parity shrinks, and this favors the EU investors. For the 1-year basis, has the widest deviation from covered interest parity, which tends to favor an investor in the United States, in the foreign economy. The graphical representation of the variables in this paper are presented. Here, first we have the basis, and you see that around 2008 and 2011-12, the basis suffered the most hit, which of course, as a result of the global financial crisis in 2008-2009, and as a result of the Eurozone crisis in around 2011-2012. The credit spread for the Eurozone was flat throughout the observation period, and for the United States, it fluctuates throughout the period under consideration. For economic performance, the economic performance suffered most hits around 2020, with the EU economic performance suffering the most, which is a result of the COVID-19 virus, which led to closure of many economic activities, and resulted in a reduction of economic performance in these two countries. For inflation hit the all-time high in the observation period around 2020-2021, which of course is also attributed to the emergence of the COVID-19 virus. Here I present the simple regression result to test empirically the theoretical proposition. And here you see this is the difference of the expected inflation in the EU. Our theory says that if the inflation in the domestic economy, which is the Eurozone, if it is increasing, if inflation is increasing, it means the cross-currency basis will do what will widen, and CIP deviations will widen further. However, what we are seeing here is that with increasing inflation, the CIP deviation becomes even tighter. For the expected inflation in the United States, only the 1-year tenor conforms with our theoretical proposition, although it is not significant. For the economic performance in the EU implies that the CIP deviations will shrink. However, here, with increased economic performance or increased good economic outlook in the EU, the results from this regression shows that the basis will continue to widen, mostly for the 1-year tenor of basis. In the United States, an increase in economic performance would continue to widen the basis, which is of course what our result showcases. Here we see that in all three tenures, the basis continues to widen. That's negative. So the basis continues to become negative as economic performance in the foreign economy continues to improve, with the 5-year basis and the 10-year tenor basis being significant. But increase in credit spread in the United States implies that in the EU, the Eurozone, implies that the basis will continue to converge back, continue to converge back to equilibrium. But this isn't the case, as the result shows. The result here shows that it continues to diverge, with the 1-year basis diverging the most. For the United States, this conforms with our theoretical proposition. Number of observations for each of the basis tenor is 260. Then, to understand the evolution of the basis over time as a result of the shock from the independent variables that are considered, I estimate the structural VAR model, and the identification strategy here is implemented from Blanchard 2002, where we use the Kuleski ordering. And the ordering here is that the economic performance responds to inflation, and the credit spread responds to economic performance, while the basis responds to all the three variables. And the idea here for the inflation coming before the economic performance is because of the adaptive expectation, because price does not immediately respond to the happenings in economic performance because of adaptive expectation. And as a result, the economic agents, firms, consumers make their choice or make their plans based on the previous set of prices for the goods. And as a result, the proposition here is that the economy responds to a shock from inflation rather than the way around. And the credit spread responds to shock from the economic performance other than the way around. And the credit spread responds to the three of them, which is of course the major idea that underpins the estimation of the structural VAR model. For the 1-year tenor, here we see that for inflation there isn't much deviation, but first the basis was negative. This was negative at first as a result of the shock to inflation. The shock to inflation causes slight deviation from covered interest parity, but then becomes positive. Here at first it's also negative as a result of economic performance, then converges. This shock dies off eventually. The credit spread has the most effect. The shock to credit spread has the most effect in the cross currency basis, where we see that the response of the cross currency basis was negative at first for some time before it eventually before the response eventually dies off. For the 5-year tenor, we see that inflation, the result remains similar to that of the 1-year tenor. And for the economic performance, there was no the deviation, the response of covered interest, the cross-currency basis isn't that much for the economic performance. So economic performance tends to explain just a little of the deviation from covered interest parity, but credit spread explains the most, as you see here. Most negative until it eventually died off. Yeah, for the 10-year tenor, 10-year currency basis, we also see that inflation, although most of the time it was negative, but the variability, the response isn't that large. For outputs, which is economic performance, it is as if the shock to outputs does not explain at all the response to covered interest parity. And again, as we have seen, right from the first tenor, the 1-year tenor to the 5-year tenor, the 10-year tenor also showcases similar properties. When there's shock to credit spread, the response of the cross-currency basis is negative, which means that it explains much of deviation from covered interest parity. To account for the variability and to explore the explanatory power of each of these potential drivers of covered interest parity, I employ the variance decomposition of the currency basis. And we see for the 1-year tenor, you see that on average, inflation only explains about 2% of the deviations from covered interest parity, while output explains on average about 5% of covered interest parity, and the spread, the credit spread, explains the largest of the deviations from covered interest parity, which is on average about 14%. For the 5-year tenor, the same result holds. Inflation explaining about on average about 2%, but the effect of the explanatory power of output reduces to an average about 1% from an average of about 5% from the 1-year tenor basis. And this implies that the output, economic performance, only explains the largest variation in deviation from covered interest parity when the tenor of investment is low, about 1 year. Credit spread continues to have the most explanatory power as far as deviation from covered interest parity is concerned. For the 10-year basis, we see that the outputs has reduced further. The explanatory power of outputs has fallen further. Explained on average about 0.2% of the variation in cross-currency basis. Inflation still maintains the average of 2% variation in cross-currency basis, while credit spread explains about 7% on average in the cross-currency basis for the 10-year tenor. And you will see that credit spread, as the number of years increase for the investment, it tends to explain less of the variation from covered interest parity. You see from here about 14%, and here 7%. But the major result from this variance decomposition analysis is that credit spread explains the most of the variations from in the currency basis, which by implication explains more of the deviations from covered interest parity. The conclusion from this paper is that yes, inflation has some effects on cross-currency basis, although not large. Economic performance also has this variation, explains a bit of the variation for in covered interest parity deviation, also not large. However, credit spread matters the most as far as deviations from covered interest parity is concerned, given which is relative to the other independent variables or the other potential drivers that were established in this paper. The policy implication that emanates from this paper is that when financial market participants are trying to make hedging decisions or trying to explore the arbitrage opportunities in the cross-currency swap market, credit spread is of crucial importance and should be taken into consideration when trying to make hedging decisions in the cross-currency swap market. And then we have the direction for future research. For this, in literature, excuse me, in literature, there have been many pathways, as this paper has also identified, which is credit spread, that explains the continued deviation from covered interest parity. Another paper, a recent paper, is that of Chika, who will be also presented today, through which oil price channel explains further deviation from covered interest parity. Now, the idea here is that there are possibly more factors, more potential drivers of covered interest parity that are not yet established, and a good research, potentially good research would be to explore further drivers of covered interest and parity deviations in the cross-currency swap market. Another idea would be to consolidate all the identified drivers, synthesize all these drivers, and to establish which of these drivers has the most potent, is the most potent as far as the deviation from covered interest parity is concerned, and which one is the weakest. Why the established factor is the most potent should be established, and the reasons for this should also be justified, and why is the particular factor the weakest should also be justified. And this is another potential research worth pursuing. The last one relies on the idea that a firm or a bank in a domestic currency, in the domestic economy, can engage in a bank in the domestic currency and domestic economy has a subsidiary in, say, the United States. So, for example, we take two economies. One, for example, in the Eurozone, which is the domestic economy, and a bank in this domestic economy has a subsidiary in the United States, which is the foreign economy. So if there is continued deviation from covered interest parity, the bank, the subsidiary of this bank in the United States, have easy access to the dollars, and as a result can access dollar and engage in cross-currency swap transactions. And as a result, we'll be able to provide more domestic currency to the branch in the domestic economy. What then happens? It implies that the credit supply of the domestic currency will increase, because now the domestic bank is able to access the domestic currency at a cheaper rate, and will now be able to provide this will now be able to provide credit supply to business owners, investors, and consumers at a cheaper rate that is lower than the existing interest rates in the domestic economy. As a result, by the fact that the investors now have access to more capital, businesses are able to engage in more businesses, consumers have access to credit, then economic performance will improve. So this paper, the idea of this this potential research is that there's a triangular relationship between credit spread, between economic growth, deviation from covered interest parity, which is a reduction in the cross-currency basis, and credit supply. So if there is deviation from covered interest parity, that is the cross-currency base reduces, then credit supply increases for the bank who has a subsidiary in the foreign economy, because the bank in the domestic economy is now able to provide more access to cash, more access to credit for business owners and those who need credit in the domestic economy, and as a result causes economic growth in the domestic economy. And this ends the presentation for the new testable theory for deviations from covered interest parity presented today. Thank you so much for this.
Thank you very much, Salako, for the talk. Well done. So please, if there are any questions on what Salako has presented, anything that is not clear, or if there are comments or suggestions for improvement, we would appreciate if you could let us know. Any questions, comments, suggestions for improvement?
All right, good evening. Good day, sir.
Oh, good day.
This is Opel Yekomi. Thank you, Mr. Salako, for the presentation. Hello? Hello, can you hear me?
Yes, we can hear you.
Okay. Okay, thank you, Mr. Salako, for the presentation. Please, can you go back to the theoretical framework?
Here, right?
Oh, yeah, yes, there.
Okay.
All right, could you just maybe explain more, all right, the equation? All right, I think this is a real business cycle model, right? I guess,
yeah.
Right?
Yeah.
All right, could you just explain more? Yeah, explain more. And I think in the following page, I think you solved the model, right?
Yep.
All right, could you just, because I think you were fast there, could you just maybe explain that more? I think, yeah.
Yeah, could you give me clarification?
So just
where
start from
you would like me. Okay.
Yeah, start from the equation itself. Yeah, from the objective function and the constraint. Yes.
Okay, thank you. All right. So the idea here is that we consider a rational agent that tries to purchase or invest in two classes of debt, right? And the first one is denominated in the local economy, or the local currency rather, which is the euro, right? And the second one is denominated in the foreign currency, which is the US dollars.
Okay.
So we consider here that this is the utility function, right? And the agent chooses the right amount of bond securities owed and consumption to maximize its lifetime utility, the UCT, right? This is just a discount factor beta, right? Right. So the budget constraint here we have the total use of resources, and this is the total source of resources. By source of resources, what do I mean? Here, at the beginning of the period, the agent, of course, this is the bond, the debt security in the local currency. BL, L means the local currency, and I is international or foreign economy, right? So this is the interest that is paid in addition to this. But then, you know that above this benchmark interest rate, there's a credit spread that is attached depending on how risky that debt security is. Are you following me?
Yes, I'm following you, yeah.
So this is the total return that will be accrued to this agent, right, in the domestic economy, and is denominated in domestic currency, right? Now,
sorry, Mr. Salako. So that thing in parentheses, all right, what does it speak to? Does it speak to the forward exchange rate, or I'm just trying to understand that? What does it speak to?
No, this is just like, okay, so I want to engage in a transaction. So I want to invest in a particular security, say bond, right? There will be an interest rate that will accrue to me.
Okay.
Isn't it? Right? But above this particular, because we are considering corporate bond, and it is considered more riskier than the treasury bonds, which is a safe asset, because I mean a country, well, that is relative, but a country, it is hard for you to eventually say a country that will default that will default, right? So, but then the corporate entity could just collapse, just as the likes of the Lehman Brothers, around 2008, shortly before the global financial crisis, right? So there is this spread that is attached to the interest rate that you have to pay, which guarantees that, okay, if eventually the bond does not fall through, or the returns does not, fall through, then I will still have something to hold.
Yeah.
You understand? So that is this spread that is paid in addition to this interest rate.
Okay.
Right. So it is more of what is accruing to me, right, as a bond. So someone who is trying to invest in a bond security. But here, so this is, if you expand this is just like the actual bond itself times 1, right? Then this would be a percentage interest, isn't it? Multiplied by the percentage of the bond that that is agreed, or the prevailing interest rate, right? And this will also be a percentage of this bond. Do you understand? So BTL1, that's BTL itself, then BTL IT minus 1, which is a fraction of the bond, and this is also a fraction of the bond itself, right? All denominated in the local currency.
Okay.
Is that clear?
That's clear. That's clear. So just go ahead with the other components.
Okay. So the idea is similar here. However, we say that this particular agent engages in a cross-currency swap transactions. And the idea of CIP, right, is that I try to invest in another country, right, to take advantage of whatever it is that's going on there. Okay. Now, in the cross-currency swap market, this is how it works. When I try to invest, there is an agreed forward rate, because I want to hedge against the exchange rate risk. Because if I invest now, I mean, if I want to exchange my money back to the domestic currency in the future, the exchange rate might not be the same, right? So in this market, I agree to a forward exchange rate. That is, this is the percentage or this is the amount that I'll be exchanging, or this is the rate rather, that I'll be exchanging my money for
back to the domestic currency
when my investment matures.
Okay.
Right? So this is the F, right? And the rest, so this ST minus 1 is just saying when you convert back to the domestic currency, it's just more like a spot rate that is used to convert the money back to the domestic currency. So, sorry, to the foreign currency. So if I have a foreign currency now, at first I'll convert, right, to the domestic currency, right? So because I want to trade my domestic currency, right? Isn't it? So this is the bond itself, the bond in the domestic currency now, not international. But then the investment is international. Sorry, in the foreign economy. So this is the interest rate that is being paid. The interest rate that is obtainable in the foreign economy.
The foreign market,
and this is the spread.
Okay.
Remind you, this spread could be different because it is not the same economy, isn't it?
Yes.
Right. The spread could be different, right? So,
sorry, let me interrupt you and ask. In addition to Okoyekomi's question, something just came to mind. So, which do you think would be bigger, the spreads in the Eurozone or the spreads in the US? I mean, in your general view, it doesn't have to. It's an open-ended question. But which do you think would be bigger? Then you continue with Okoyekomi's question. Sorry about interrupting your question, Okoyekomi. This just came to mind.
Oh, yes, sir. That's right, sir.
Yeah. So the spread in the United States is likely to be bigger than the spread in the Eurozone. And why
do you think that would be the case? Why? I mean, this is just your view, but why do you think that would be the case?
I say this because I think that since it becomes more attractive when you trade in the United States, and the returns, because of the good economy, and other features of the market in the United States that are quite attractive, then the spread here will be more when compared to relative to the Eurozone spread.
That's a good point. Another point that I will quickly just add is that, the Fed has been tightening, okay? The Fed has been tightening. So the interest rate differential between the US and the Eurozone has increased in favor of the US. So for corporates here in the US, to attract investors to come buy their bonds, they have to provide a higher spread, much higher, to compensate people, to prevent them from going to invest in treasury bonds, for example, and to encourage them to come and invest in them, okay? So this is another reason why, to support your view. However, there could be some other argument why some people might think that the spreads in the Eurozone will be higher than the spreads in the US. But yet, you have a good point. Quickly summarize Opoyekomi's question, your answers to Opoyekomi's question, so we can see if other people have questions. Because you've spent a long time. Yeah, you did an excellent job explaining the model, but
yes. All right, you can just keep, Mr. Salako, you can just keep to the solution of the model, of the real business cycle model. I think I already, understood the components of the constraints, so just keep to the solution here.
Yeah, so the solution here is just that this is the technology augmenting economic performance. And the idea is just that if the economic performance increases in the foreign economy, which is represented as this, right, it will be negative. And as a result, the cross-currency basis becomes more negative. And a negative cross-currency basis implies that deviations is widening, right? But if the economic performance in the local economy is increasing, then the basis tightens, right? And so the idea here is also that if the spread in the international economy, or the foreign economy, if it reduces, right, then if it increases, then spread continues to widen. And the spread here, if the spread in the local economy increases, the spread shrinks. Sorry, the cross-currency.
Thanks, Salako. Let's see if we can get another question, and then we can move to the next speaker. We've already spent too much time having you present this work. So is there any other question, please, so we can move to our next speaker? Any other questions? Any other questions?
Hello?
Hello?
Yeah, hi. Hi, Salako.
Hi.
Yeah, so I wanted to find out what reference rate or interbank rate was used to calculate the basis swap spread you used.
The LIBOR cross-currency swap rate basis, the LIBOR rate. Yep.
I see. When does your data end? Because they stopped using LIBOR. I think Kagba can speak more about that because he's an expert on LIBOR and things like that. But when does your data end? Does it end in December 2022, or it progressed after December 2022?
I think it ended around 2021.
Oh, 2021.
Towards the end of 2021. Yeah.
Okay, LIBOR was still in use at the time. Okay. So that's correct. That was LIBOR based. Okay. Right.
All right. Okay.
So now they use SOFR and some other reference rate. SOFR, then Esther, depending, but there is a new reference rate now in the financial markets that started because it is easy to manipulate LIBOR. So the financial markets decided that they would use more reference rate. I don't know if Kagba is online, but he can speak more about that in the next part.
Yes, I read in the OLAP project, I came across something like that, which was referenced, and I was curious as to how could it be manipulated? What are the things that have been
people have manipulated it, and people have gone to jail. There is a trader from Barclays Bank that went to jail a couple of years ago because of manipulating LIBOR, but we'll talk about that later.
Yeah.
Is there any other question? Oh yeah, Kagba wants to say something. Yeah.
Oh yeah, okay. I'm online. But we are still using the LIBOR presently. Yeah? We are switching to SOFR, but it will cease in June 2023.
Oh,
So this June.
2023. Okay, so I'm not as
Yeah,
recent.
Labo is going away in next June. Okay. Yeah.
Okay.
Thank
you. Okay. Yeah.
Thank you.
Thank you for that point. Any other questions?
Yes, I would also like to ask, sorry, I kind of came in a bit late. The difference between the foreign, the FS swap market and cross-currency basis swap market.
Could you repeat that again, sir?
Yeah, I'm asking the difference between the FS swap market and cross-currency basis swap market.
So the cross-currency basis swap market is the basis that is associated with the hedging strategy in the cross-currency swap market. For the excess swap, then that is just the money market exchange basis. I hope I am correct. So that is my answer.
Okay, are there any final questions for Salako? And then we move to the next speaker. Any final question, one or two more final questions? It can be from the same person who just asked or from somebody different. Any final questions?
Yes, yeah, going through the work, so that you say the basis has persisted for some time. Did you consider transparent costs, and how will transaction affect the basis? And how has the transaction cost affected the basis too?
Yeah, so in Do, a paper published by Do, I think in 2028, yeah, I think came out in 2028. So it has been established that even with the presence of transaction costs, right, the basis still widens, right, and covered interest parity deviations passes, even with the presence of transaction costs, right. So this has already been established in literature. I hope that answers. So I need not to consider that in my analysis, at least from the knowledge of the extant literature. I hope I'm answering the right question.
Yes, you are. Thank you.
Okay, thanks.
Okay, so thank you very much, Salako, for your presentation. We've exceeded the time limits actually, but it was for good. Our next speaker will be Bukra El Rabani. So please, can you give the access to Bukra so that she can present her work? And she'll be talking about using machine learning techniques like neural networks to predict the Moroccan stock market. So this is what Bukra El Rabani will be talking about. So Bukra, can you take the floor, please?
Good afternoon. Can you hear me?
Yes, we can hear you.
All right. Please let me know if you can see the screen.
We can see the screen.
Perfect. So first of all, thank you so much for giving me this opportunity for presenting this work in front of you. So this project is about stock markets prediction using a hybrid of deep learning model, which is presented by myself, Bushra El-Rabbani, and supervised by Dr. Akayemi Mari and Dr. Shika Banju. So in order to have an overview about this project, we'll start by the table of content. We'll start by the problem statement to understand well this project, and then we will talk about some literature review and previous work that have been done regarding this topic. Then we will talk about some proposed approach to determine the stock market's prediction using deep learning, and then we will discuss some data analysis using Python, and at the end of this presentation we will discuss some results that we get after implementing all methods of deep learning. So in this project, we are going to talk about stock markets as a dynamical system and how can we predict stock markets price using modern method in data science and deep learning. And this is really exciting because we have an explosion of data nowadays. And at the same time, the algorithmic in machine learning and data science, which is a kind of applied math, statistical optimization technique are getting much better comparatively to the past. So that we have a great combination of big data from one hand and a great new method that can help us to tackle the dynamical system challenges. So as you know, stock market is a network of stock exchange where traders and investors buys and sell shares of publicly traded company. Again, stock market is real and continuously evolving, extremely complex dynamical system. Uh, Here we will talk about some characteristic of stock market. So stock market is characterized by uncertainty, and this is due to the randomness of time series data, which make it complex and volatile and very hard to predict. That's why stock markets have been an interest of many researchers, and I can cite here some papers that discuss the same topic. So I can start by Hiransha in 2018, who used the deep learning model architecture for the stock market's prediction of National Stock Exchange of India and New York Stock Exchange. He or she used different deep learning models, including MLP, which is multiple layer perceptron, RNN, which is recurrent neural network, LSTM, which is long short-term memory, and CNN, which is a convolutional neural network. And we can get three main results from this paper, which is the first one. The autoregressive integrated moving average ARIMA is not capable of identifying an underlying within various time series, and this is because ARIMA is considered as one of a linear model, while the DL or deep learning model are outperforming the ARIMA. The second result that we can get is that the convolutional neural network has performed better than other three network, which are LSTM, CNN, and MLP. Again, what I can remark from this paper is that they didn't explore the advantage of combining several networks and get a better performance. Another paper is given by Hamoudi and LSCFI in 2020, who considered stock market price prediction as a binary classification problem. It's another kind of technique because most of paper are considering it as a regression problem. But here he considers it as a binary classification problem with a positive class chosen as the trade resulting in the return within the first 10 percentile of all return in the training option. And CNN, which is convolutional neural network, and LSTM model again is used in this paper. Another example is Patel and al. In 2021, who introduced and reviewed more possible ways to predict stock movements with a high accuracy. And it was found that the most appropriate method for stock markets prediction is to use multiple algorithms such as INN, artificial neural network, RF, random forest, support vector machine, SVM, and LSTM. So what we can remark from the literature review is that the most used method are CNN, MLP, and LSTM. Some of them are considering CNN is outperforming, while others considering LSTM. That's why my first question that comes to my mind is to do a comparison between those top method, which are LSTM, MLP, and CNN. So that was my first aim of this paper. Then the second objective is to design and come up with a new model that will exploit the hybrid of different deep learning models. So in order to understand the approaches I presented in this scheme, so we can consider this problem as a supervised learning, because it uses to learn models from the label training data, and it enable an output prediction for future and ensuing data. Again, we consider it as a regression model, since we are predicting stock market price, which is a real number. And in order to have a better understanding of the approaches, we can see here two approaches. The first one, which is in the left hand side, the aim is to use deep learning models separately and establish a comparison in order to achieve the first goal of this paper. So we implemented MLP, multi-layer perceptron, and LSTM, long short-term memory, and CNN, convolutional neural network separately, and we did a comparison in terms of performance. Again, the second approach is aims to combine several models like CNN, LSTM, and MLP in such a way that we take the output from CNN and the output from LSTM and the output from MLP, and we consider it as an input of a new method or a new model that we consider the hybrid, and that we will train in order to get a better performance than those existing methods. So before the implementation, I will give some definition and concepts and general view about artificial neural network. So artificial neural network, or INN, is inspired from a biological neural network that constitute an animal brains, and they are built by assemblage of a large collection of units that are interconnected in some patterns to allow communication between these units. So we can see here from the figure that we have different units with different colors. We can see the units in the black, and again another unit in the white and the blue. So the black one constitutes the input of our network, and then the white one are the neurons in the hidden layer, and the blue one is the output. So generally this one is a one hit with one hidden layer, but of course we can have different structure with different layers. That's why we consider layers, the number of layers, as one of hyperparameters of our architecture. And again, inside each layer we can have several neurons which constitute another hyperparameter. And we can see that these units are interconnected with each other, which allows the communication between the units and transfer the information from one unit to another one. In order to understand what's happened exactly inside each unit and what are the mathematical interpretation of each unit, we will see that on the next figure. So this figure represents one unit, which is one neuron that receive different inputs. We have here a vector of inputs x1, x2, x3 up to xn, and each input is linked to this neuron with the weight w1, w2, w3 up to wn. And then inside this neuron where the computation is happen, we have products between the vector w and the vector x, and then we add the bias. After doing this computation, again we apply another computation, which is the activation function. So we can see here from this formula that z, which is the output of this neuron, equal the summation for I goes from 1 to n of xi times wi plus b. And then after getting this this output, again we apply the activation function. So this is what happened in one neuron, and the same thing happened in all neurons. And as I said before, the architecture of this artificial neural network can differ from one model to another model, and we can determine it by giving some values to the hyperparameters, which are the number of hidden layers and the number of nodes inside each layer. So for the performance evaluation, we have used three types of performance evaluation. The first one is the mean square error, which is represented the distance between the predicted y, which is the predicted vector price, and the actual vector price square. We do the summation over all instances and all data points, and then we divide by n, since it's the mean. The second performance evaluation metric is root mean square error, which is RMSE is a, which is equal the square root of the mean square error that we get before. The third metric is the mean absolute error, which is MAA, which equal to 1 over n summation over all data points that we have of the absolute value of yi minus y hat I. Now we will move to the theoretical part of the hybrid model. So the hybrid model is given by the following equation, which is z equal w1x1 plus w2x2 plus w3x3 plus b, where x1, x2, x3 are the inputs of this model. W1, W2, W3 are the weights plus the bias b. Here z, of course, it represents the vector price of the model, and x1, the first inputs, are in reality the output of the LSTM model with the best performance of the LSTM, and x2 is the vector price output of multiple layer, and x3 is the vector output of convolutional neural network model. So this is the hybrid model, and what we want to do is, first of all, we initialize W, which is the vector weight, W1, W2, W3, by the following values. W1 is the total, where here the total is a summation of all mean square error of 3 models. The total minus mean square error of the first model divided by the total. W2, which is the weight of the second model, which equal total minus the mean square error of the second model divided by the total, and the weight 3 is the total minus the mean square error of the third model divided by the total. So those are the initial value of the weight, but of course we need to train this model and then come up with the optimal value of with the right value of W1, W2, W3 that give us the minimum error of the hybrid model. That's why the main objective of constructing this new model is to obtain a better approximation of the vector price W. In order to achieve this goal, the mean square error will be considered as the performance evaluation function. Thus, the below optimization model will be considered. So here we have the loss function, which equal 1 over n, the summation over all data points from I equal 1 to n of zi minus yi square, where zi here is the approximated value of the vector price using the hybrid model, and yi is the real vector price that we have, and our objective is to minimize this value, and the variable that we are looking for are the W1, W2, W3 that we have in our initial model. In order to solve this problem, we are going to use the gradient descent algorithm that aims to determine the best vector W that minimize our cost function. And the gradient descent basically is the focus on the derivation of the loss function with respect to Wt, W1, W2, W3, and we will need again to derive Wb. And then the implementation of the gradient descent is done using Python. So as application of this project, we used 2 data sets, which are EM historical data and Bank of Africa. Those are 2 enterprises that belongs to Casablanca stock market. And this table represents a summary statistics of dataset 1 and dataset 2. So for the dataset 1, we have 3,000 elements, and for the dataset 2, we have 748 elements. And here we can see some statistical parameters like the mean, the standard deviations of both datasets. Again, we have done some statistical tests like stationarity test for the both datasets, for the dataset 1 and for the dataset 2. And from the p-value, we can see that for the first dataset, we have 0.38, which is greater than 0.05. And for the second dataset, we have the same thing here, 0.61, which is again greater than 0.05, which means that both of datasets are not stationary. Another statistical test is heteroscedasticity. We have implemented this test using Python, and we used Bronscher and Pagan test. And we can clearly see from the p-value that the heteroscedasticity is present in the both datasets. So after implementing the first approach, which aimed to implement separately each deep learning model, LSTM, MLP, CNN, and the second approach that use a hybrid model, we get the following results, which is summarized in this table. So we have the summarized table for the first one, which is correspondent to the first data set, and the second one, which is correspondent to the second data set. We can see from the data set 1 that CNN is performing better than MLP and better than LSTM, since the performance here is minimal comparably to MLP and LSTM. And it is the same thing for the dataset 2. We have CNN again, it's outperformed MLP and LSTM, while the hybrid model performance is much better than CNN for the first dataset. And again, the hybrid model is much better than CNN model. So in conclusion, we can say that CNN outperformed LSTM and MLP for the both datasets, while the hybrid model and the exploitation of combining several models can come up with a better performance. So thank you for your attention.
Thank you very much, Bukra. I have a question. Let me start by asking questions before I open the floor for other colleagues to ask.
Yes.
So you used two tests of non-stationarity, stationarity, the ADF, augmented Dikifula, and the KPSS, some long name like that. So would you like to tell us what the null hypothesis is in each case? Are the null hypotheses the same in each case, or are they different? And also your test for heteroscedasticity. You use the Bruch-Pagan test for heteroscedasticity. Okay, so what is your null hypothesis? It's important so that people can know what the null hypothesis is, and then what the rejection of the null hypothesis implies. So let's start with the augmented Dikifula. What's the null hypothesis in that case?
So for the stationarity test, the null hypothesis is non-stationarity. We assume that we have non-stationarity.
That is for the ADF, right?
Yes.
For the ADF, and if you do not reject the null hypothesis, then you conclude that there is, you may conclude that there is a high evidence, not 100%, but there is a high evidence that there is non-stationarity, right? Based on the ADF. Okay. What about the KPSS? What is the null hypothesis there?
The KPSS. Okay. Sorry, I'm not sure.
Can you show the screen, that part where you have the tables? Where you have the, yes. Okay, yeah, go to the KPSS. Okay, good. So what's the null hypothesis for the KPSS? Okay, so let me help you with that. Let me help you with that. You can see with the two results, you can notice that for the ADF, you are not rejecting the null hypothesis. And so because of that, you are concluding to some extent that there is non-stationarity, because the null hypothesis there is that there is non-stationarity. Okay. Now you notice for KPSS, you're actually rejecting the null hypothesis and you are concluding that there is non-stationarity. So that would mean that the null hypothesis for KPSS and for ADF are not the same. While for ADF, you are testing for non-stationarity, it is important to note that in KPSS, you are testing for stationarity. So the null hypothesis for KPSS is stationarity. And if you are rejecting the null hypothesis for KPSS, what you are in fact concluding is that there is evidence that there is non-stationarity because you are rejecting that hypothesis. Okay? That's clear?
Yes.
Okay, so you see now. All right, so let's allow, and then the third one, would you like to answer the third one or you want me to give you insight? The third one
For the homoskedasticity?
Heteroskedasticity. Yes, what's the null hypothesis there?
The null hypothesis is
yes.
Heteroskedasticity is not present.
Okay, so let's look at the table. Okay, so the null hypothesis is that heteroskedasticity is not present. Okay, so when heteroskedasticity is not present, you're saying that there is what?
Homoskedasticity.
So the null hypothesis is homoskedasticity. And if you are rejecting the null hypothesis, then it means that you're saying that there is evidence that there is. Good. Okay, so that would be my question. I think Nathaniel has a question. Nathaniel, please ask your question before we move to the third.
Okay. Thank you, Botra, for that presentation. So I have two questions. So the first one is, out of all the methods that you use, which one is more better? You know, like towards the last part, you presented 4 different methods that you use in analyzing your results. So I want to know the one that give you a better result towards your conclusion.
Yes. So I don't know if can you see here the table, performance evaluation table. So we have here 2 data sets. We have data set 1 and data set 2. For the data set 1, we have LSTM model, MLP model, CNN model, and the hybrid model. And we have the 3 metrics that we used: the mean square error, the root mean square error, and the mean absolute error. So the one with the minimum value is the one with the high performance, since here we are relating the performance to the minimum error. So we can say from the first line here, for example, that CNN is better than MLP and better than LSTM, since here 6.12 10 to the power minus 5 is less than the 2 values. But when we compare this CNN alone to the hybrid, we can conclude that the hybrid is much better. This one, this conclusion is based on the mean square error, and the same conclusion we can conclude the same conclusion using the second metric and the third metric as well, because in the hybrid part we have the minimum error comparably to the other models. And if we analyze the result of the data set 2, we can see that again CNN is much better than MLP and LSTM, since 1.7 is less than 1.7 to the 10 to the power minus 7 is less than 5.58 to the power minus 7, and less than again to the performance of the LSTM. But when we compare this one, which is better alone, to the hybrid, again the hybrid is much better than CNN. And this conclusion goes with the other metric, which is root mean square error and the mean absolute error. I hope I answered your question.
Okay, so what you are saying now is that the data set 2 is more preferable than the data set 1.
Can you please come again?
So what from your conclusion, can we say that the second approach is more better than the first approach? considering all the.
Yes. Yes.
Okay. Then secondly, thank you for that. Then secondly, so I didn't get the full meaning of that CNN. Can you please give me the full meaning? CNN.
CNN is
this is a news station. Bokra is a news. You know the CNN news station?
Sorry, I couldn't hear you clearly.
Yeah, okay. So yeah, please answer his question. Answer Nathaniel's question.
Conventional neutral network. I didn't get this very well. CNN, the full meaning, please.
I think we have lost Bokra. Bokra, are you there?
Can I make a quick comment?
Yes, please.
Yeah, regarding the last question, the last person asked now, he was asking whether data set 2 is it better than data set 1. So so in this case, we are not comparing the data set, we are comparing the model being used. So so she said that hybrid model is better than other model. So she's using 2 data sets to actually confirm that regardless the data set you use, you should still have hybrid model perform better than other models. So in this case, so our conclusion is not that data set 2 is better than data set 1. Our conclusion is that hybrid model is better than the other 3 models. So she could have used, you could also use 3 data sets to just reconfirm. So we are not comparing data sets. So just to answer the question the last person asked.
Thank you so much, Kazim. Yes, this is very important, an insightful answer. So the data sets are not being compared. The things that are being compared are the performances of the different techniques. And as Kazim rightly said, these performances can be compared on like 1 billion data sets, if you can get 1 billion data sets, or on just one time series, maybe the Nigerian Stock Exchange Index, any number, just comparing this, is a form of robustness check. Nathaniel, you know what robustness check is? So you want to see how strong or how solid your result is, and you keep trying it in different scenarios, different cases. Like, for example, you try something in the US, you try it in the UK, you try it in Nigeria, you try it in all of the countries in the world to see if it is true or not, okay? So that is something similar to what she's doing. Okay.
Hello. Yeah,
yes,
I have a quick question.
Okay, is Bokra still online, please? Because the question is for her. They are not for me. She's the presenter. Are you still online, Bokra? I think we've lost her, but let me allow you ask your question.
She's still on the call. Well, I don't know. I think her network is frozen. She's still on the call.
Okay, please go ahead and ask your question. Can you tell us your name and then you ask your question quickly?
Sure. So this is Kaba.
Oh, Kaba.
Speaking. Yeah. I have a few questions on the theoretical side, actually. I'm not familiar with machine learning, but first I would like to ask, because what I've seen on the modeling side is that the model that represent each of the nodes is a kind of a linear formula. You have some input, and so you said you got some weight, and then you do the linear product of these two inputs, basically, right? So my question would be that by any chance, is there a non-linear version of this model? So this is the first one. Second one, this is to have a better understanding of what's happening. So when you talk about weight, the W that I'm seeing in the model, for example. Do the weight add to 1, or like is it like kind of general weight? That one also I'm not, this is just for my own understanding, because on the initialization side, I think for the 3 weight W1, W2, and W3, you said that you initialize these to like total minus MXC1 over total, and then W2 is total minus MSC2 over total, etc. Then the thing is, when you sum up these weights, they don't add to 1, they add to 2. So so my understanding is that these are not really normalized weight. So is this am I understanding correctly, or is there something that I'm missing? Thank you.
Hello, Bokra, are you there? No, we can't hear you.
Oh.
Hello, Bokra, we can't hear you. Okay, unfortunately, these were very good questions from Kagba about the possibility of having nonlinearities, and then about whether the weights actually sum to 1, and if they do not sum to 1, are these different kinds of weights or they are the regular weights? This would have been very good questions for Bokra to provide our insights and our answers to. Unfortunately, we would have to.
Excuse me.
Yeah.
Hello, can you hear me?
Yes, we can hear you.
Yep.
Yeah, so, well, I don't know why Botra is not on, but for the linear and non-linear neural networks, there is linear neural networks and there are non-linear neural networks. So for the neural networks, when you have the one without activation function, that works for a linear neural network. But with the one that has activation functions, you can categorize that as non-linear networks. But for her weight, I think she will be able to tell us how she made the weight, how she added the weight to be able to give her the summation she got. Because that will show on where she was actually coding it, using the Python when she was doing the analysis. She should be able to say what she used in that line, maybe when she comes online.
Can I help?
I don't know if that's answered. So there is.
Yeah, we can hear you now.
Okay, yeah, you can.
Wait, she didn't do when you normalize, usually in econometrics, you will take a total and pretty much you're normalizing with mean 0 and variance 1. But that's not what she did. What she did was to normalize each mean square error. So if you when she comes back online, she can scroll up to where she did the ways where she took the mean square error of each and then standardized based on that. So, but if she had standardized based on a general mean square error, then it will normalize to mean 0 and variance 1, but that's not what she did. So okay, that's what she's displaying right now. Busha, you can stop there. So notice that she was normalizing for each one separately, not generally, and then she then summed up each of them. So that's why it won't add up to 1. But this is good feedback that we can look at for future work to see how we can find a way of developing weights that would be properly standardized, which would come to mean 0 and variance 1. Does that answer your question, sir?
Yes, definitely. So I see. So this set of weight are chosen so that to have a given mean and variance, right? Something like that.
Yes.
Yeah.
But unanimous.
Okay. Yeah. So, but yeah, you know, what I was asking is whether like so because when you use the word weight, usually people tend to think that it's normalized, it's added, the weight should add it to 100%, something like that. So yeah, that's why I
You're very correct in that assumption. You're very correct, which I think is something that you know, throwing that word weight around was something we probably didn't look at more intensely. Maybe we should have called it something else. Maybe it should have been maybe like an index or something, a coefficient, as against calling it a weight.
Yeah. Okay.
Maybe the word there should have been coefficient. But thank you.
yeah, exactly.
Right. Yeah.
Feedback to
Thank
have.
you very much.
Thank you. All right, thank you very much, Bokra. So our third speaker now will be Mohadesi. Mohadesi will be presenting our paper on applied micro development economics. And the paper focuses on Nigeria, interestingly, looking at wealth, health insurance schemes, and access to health care. So Mohadesi, I hope you have the host permission now to begin your talk.
Hello. No, I think I don't. No, I'm
yes,
not
we can
the
hear
host.
You're not the host?
No, I'm not yet.
Bokra, can you give her the permission to be the host? Okay, I think you are now. Mohades.
No, I'm not.
You're not?
No. Yes, yes.
You are now. Okay.
Yes. Hello, everybody. First, I want to thank you because of this opportunity. This research is called Wealth Health Insurance. Sorry. And access to health insurance in Nigeria. And I have finished this research by the supervision of Dr. Professor Emma Pani. Let me stop my video to not affect my voice. As I said, this research is called Wealth, Health Insurance and Access to Healthcare in Nigeria. And the data that we are using conduct the last 2 decades, and how changes in the health schemes has affected residents' access to medical care. This has divided into 6 parts. The first part is about the importance of the study. Research questions, hypotheses, and methodology are coming after that. And at last, we will discuss about data and results. About the importance of this research topic is about high level of poverty, unemployment rate, and limited access to the medical care services lead us to design this research. And also, according to the importance of this research, the main question is in the paper is how changes in health insurance schemes impacted residents' access to healthcare in Nigeria. And our hypotheses are about new health insurance schemes in Nigeria, along with changes in the rule on health insurance coverage have led to improved residents' access to medical care. Also, this we hypothesis that contributes residents' health insurance contributes a positive effect on the availability of medical supplies. And at last, we and our third hypothesis was the insurance could ease the pressure of the healthcare expenditure by moving some of the pocket expenditure to the government and insurance companies. In this part, we review some of the related papers in the related area. The first paper has designed in 2021, and by reviewing Nigeria's health system in the last 5 decades, demonstrates Nigeria health insurance can provide health insurance coverage to less than 5% of the population. And Nigeria is faced with the health workforce crisis. Also, another research by ADBI 2021. This research by NHIS had a study on pocket payments, and the result shows residents who are covered by this scam are satisfied by the treatments that they receive. Also, it offers more support from the government, especially for low-income workers. Sorry. Another study in 2020 demonstrates that the pathway to sustain access to medicine and shows people's access have been improved over the years. Another study in 2015 investigated the relationship between health risk and poverty in historical case study, and offers that the government has to enhance its portion in healthcare expenditure by reducing out-of-pocket expenditure. There are some other studies that I want to pass because of the time limitation, but overall, all of the previous studies shows that the access to medical care in Nigeria is so limited, and the government has to interfere in this area. This study has designed into 2 parts. The first part covered the historical development of Nigeria's national health insurance scheme, and the second part evaluates the effectiveness of NHIS in the last decade and medical care accessibility for people by using a cross-sectional DHS dataset in 2008, 2013, and 2018. As I mentioned before, the first part includes a review of health insurance scheme in Nigeria. I mentioned the keywords and so on. At first, I take a glance in the history of health insurance creation that I want to pass because of the time limitation. So we are going to this slide. Now we have a historical review of health scheme in Nigeria. The first plan designed in 1945, and it was a 10 years plan. But this program was poorly structured and did not include economic targets. As a result, could not make a positive process. The next one was a plan from 1956 to 1962. This scheme focused on the status of health service, the priority of health issues, the available budget, and also it found solution based on state and development aid resources. The next plan was the first national development plan, which was from 1962 to 1968. This development plan appeared to have focused attention on trying to improve the numerical strength of existing facilities rather than evolving a clear health policy. The second national development plan, which was from 1970 to 1975, was a complication of the first program and adjust some of its problems. The third National Development Plan from 1975 to 1980 was the first unified national health policy. It developed the availability of health personnel, provide healthcare service under the basic health services scheme, have some plans to control diseases and efficient use of health resource, and design some medical research also. The fourth National Development Plan from 1981 to 1985 implemented the Basic Health Service Scheme. Plan of Primary Health Care in 1987 monitored health data more effectively, enhanced the training of healthcare professionals, enhanced the vaccination program, and so on. And this plan continues to 2000s. Nigeria's 5 years strategic plan was from 24 to 28. This plan aims to ensure every Nigerian has access to good healthcare service, protect Nigerians from the financial burden of medical bills, limits the rise in the cost of healthcare service, ensure efficiency in healthcare service, and ensure equitable distribution of healthcare costs among different income groups. And the last scheme was National Strategic Health Development Plan from 2010 to 2015. This scheme aims to strengthen the national health system and improve the health status of Nigerians, and it was a national health development plan. Overall, according to this historical review, we can say the health system continues to face challenges related to weak leadership in Nigeria. Since the country's independence in 1960, financing its health system has been a significant challenge in the country. Also, Nigeria remains challenged in terms of providing healthcare financing that is equitable and affordable for residents. Now we consider the results of the modeling or data set. Because of the time limitation, I introduced the data and model briefly. As I mentioned before, we had a cross-sectional data set, which involved data from 28 to 2018. This period contains 2 different health schemes and some years after the last one. As a result, it was able to give us a perspective of the effectiveness of the changes in the health scheme in Nigeria and its success. To modeling the data, we use logic regression, and we introduced changes in the scheme as dummy variables. This is the model. Let me introduce the variables. The variables in the model are usage of medical care for each observation, job definition, health insurance status, its wealth index, and as I mentioned before, years as dummy variables. And in this slide, we can see the results of the model. The small p-value for the chi-square statistic implies that all of the 5 effects in the model are important for predicting the probability of access to medical care. All of the 6 factors are significantly associated with access to healthcare, to medical treatment. And the result shows that having health insurance has more contribution than other factors. And the second most important factors is being job situation. Sorry. Furthermore, by changing the policies of health scheme, residents' access to medical treatment significantly enhanced over the decades, which means they had a positive impact on people's residents' access to the medical care. However, we cannot deny, even if access to medical care significantly increased from 26% in 2008 to almost 52% in 2018, just a very limited portion of the residents have access to health insurance, which is around 2.3%. The results shows the model is significant as the p-value is less than or equal to the significant level. We can say a good salary, a high wealth index ranking, and health insurance all help improve access to medical care. And the likelihood of visiting health facilities increased significantly with employment status or wealth index, and the wealth index ranking of the sample. Also, having health insurance enhanced the likelihood of seeking treatments. Since Nigeria has one of the highest population in the continent and it is Africa's biggest economy, its situation often reflects challenges that have been arose the continent. So in this slide, we take a look at the country's economy. For example, Nigeria's GDP in 2019 was $432 billion, while its GDP per capita was $2,23,000. Also, by analyzing unemployment rate based on the DHS data, we can see 27% of the households in the survey were unemployed in 2028, which is 32% in 28 and 27% of households in the last year, 2018, were unemployed. Among the residents who have access to the health insurance, increased from around 3% in the first year to 4% to 4% in 2018. Also, the major source of the health insurance is employers. Among the residents who have access to health insurance, 45% in 2028 used medical care services, where just 22% of the residents without health insurance used this kind of facilities. This portion increased to 50 and 68% respectively in 2018. Which shows a significant increase in the access to medical treatment for all residents during the time. However, still, out-of-pocket expenditure is the main source of cover to cover medical costs, and its portion is still the highest one. At last, we can conclude that only Nigeria still has a great problem with health insurance because it's just cover a few portion of the residents. Also, we can even if we can see a positive process, still just a few % of the people have access to medical care. and of course health insurance, and still we don't have a private insurance, are not common among the residents in Nigeria. Thank you for your attention.
Thank you very much, Mohammed. Before anyone starts asking questions, I have my own question that I've already written them. And you said the major source of health insurance in Nigeria comes from the employers. Is that correct? Did I hear you well? Okay.
Yes.
How, I don't know if you have done this analysis, maybe in the Middle East or in any other place, but how does this compare to other regions of the world that you have seen? Do you think this result is robust in other parts of the world, or you think it is a case that is peculiar to Nigeria?
Yes.
That is, yes.
Yeah, sorry, I interrupted you. Yes, I believe in almost all of the countries, employers are the main source of health insurance because they tend to cover the employees. However, I believe in my country, this portion is a little less than this one that we have in Nigeria. Maybe like 70% are by employers, and many people in my country are using self type of health insurance and this kind of things. Yeah.
Okay. My final question before I allow, sorry, Salako, let me ask this final one. So in Nigeria, do we have many health insurance schemes, or they are limited compared to some other regions that you are familiar with? Of course, excluding Europe and America that are much more developed compared to other developing or frontier economies. Do you think we have more health schemes, health insurance schemes, or we have less, or it's the same? Because
I
we
believe
need all of these schemes to be able to choose the one that is optimal for them.
Yes, I believe we have many scams in Nigeria. It shows most of them are not developed strongly, because when we have a good plan, the country can follow that one, and the country don't need to design another plan. I believe it's not every developing country have this portion of health insurance scheme like we have in Nigeria. For example, in Iran, the health insurance scheme are not like this, and I believe we had just 1 or 2 changes during the time over the last 500 years. 5 decades. 5 decades. Yes. They are not changing. Yeah.
Okay. Thank you so much. Yeah. So others can ask their question. Maybe we can start with Salako. Quickly ask your question, and then we'll take the last one.
Thank you so much. Okay. Thank you so much for the presentation. I think it's a very good one because it resonates with the practical experiences of Nigerians, and the rich, benefiting most from these, schemes. But my question is, why is the research particular about 2008, 2013, and 2018? Because there seems to be other times that the schemes are available, which could also be tested. But why 2008, 2013, and 2018?
It's just because of the data limitation. DHS data were from 1919, but it's not included any question related to health insurance. So I just could use the last 3 DHS data sets survey. So that contains some information about health insurance and how people have any kind of treatment and so on. Yeah.
Thank you.
You're welcome.
From Madam Mary, please, can you go ahead and ask your question?
Okay, good evening again, everyone. Thank you for the presentation. My question is just quick clarification on the data. when you say insurance provided by the employers, does that include both private sector and public sector employers or just private sector?
Actually, I don't have this data because I just use the DHS survey, and it's not distinct this to one. Yeah. So I really don't know, but I believe it's based on employer. Yeah. But I don't know.
Public sector.
Yeah, I don't know.
Yeah. Okay. No worries then. All right. Thank you.
You're welcome. Sorry.
I think we have a last question from Nathaniel before we go to our last speaker for today. Nathaniel.
Okay, thank you.
Sorry, I cannot hear you at all.
Okay, can you hear me? Can you hear me, Martin?
Yes, I can hear you now.
Okay, good. Thanks for that presentation. Okay, so my question is, you presented a graph that in 2014. There's a graph that you presented that the health insurance, there was a shoot in the health insurance in 2014, but in 2018 there was a drop. Yeah, okay, this particular one. So
this one?
Yes.
Yes.
Okay. So there's an increase in health scheme in Nigeria in 2014. But if you look at 2018, there was a drop here.
Yeah.
But if you look at your histogram.
Which one?
Histogram. In 2018.
Which one?
Yes, in 2018, yeah, there was a high health insurance scheme here. Why is it that there's different? Did you get my?
No, I really didn't get your question. I didn't know what graph you are mentioned. Which graph? This one, this page, or another one? Please let me know.
Please go back. Again.
This one?
Go back.
This?
Yes, this particular one.
This is about unemployment rate. Are you mentioning unemployment rate or GDP? Health expenditure.
Okay, this one is health expenditure. Oh, okay.
Health expenditure.
Okay, I was thinking health insurance scheme. Okay.
Okay, thank you, Mohammed,
You're welcome.
for your talk. And now we are having our last talk, which will be given by Chika Odinaka Iwagu, and she'll be presenting the dollar and deviations from covered interest rate parity, looking at the oil price channel. So Chika, you can take the floor now and be the host and then present your work to us. Thank you.
Okay, good evening, everybody. My name is Chikodinaka Zukaiwago, and I'm representing a paper titled the US dollar and covered interest rate parity deviations using the oil price channel. My supervisor is Dr. Yakilume Bagi, and I really appreciate him for all his support during my research. So to start with, my paper basically analyzes this violation of the CIP condition among 13 emerging markets and the US dollar. Also in my paper, I try to document a triangular relationship between my channel, which is oil changes in oil prices, the US dollar, and the covered interest rate parity. So basically, we will start with introduction, research questions, literature review, theoretical review, results and analysis, my model, my methodology, conclusion and recommendations for future research. To start with, there was the global financial crisis between the mid-2007 and early 2009. And basically, this crisis was more or less a pressure on the global financial markets and the banking sector. So before this global financial crisis, we realized that the CIP, which stands for the covered interest rate parity, a condition that states that the difference between the spot and forward rates should be equal to the difference between the interest rate of the two currencies involved in every FX swap. Before the GFC, we noticed that this condition was adhered to, such that the difference between both were equal to 0. However, during and after the global financial crisis, we noticed the violation amongst the two. So in general, the most thing used to capture the spread or the deviation in the violation of the CIP condition is actually the cross-currency basis swap. Now, this basis swap actually explains the difference between the direct cost of borrowing a domestic currency in its country and the indirect cost of hedging this domestic currency on the swap market. The major idea of the CCB is that arbitrager would try to borrow his domestic currency from a high interest rate environment and lend to a low interest rate environment and make such profit from hedging the cost of converting his domestic currency to the foreign currency and back, from converting his foreign currency back to the domestic currency. The reason why we're looking at the US dollar is the main fact that it is the most common currency in the global trade in financial markets. We're talking about fixed income market where you want to buy Euro bonds. We're talking about commodity markets such as oil prices, gold, and the rest of it. I also follow using the emerging market currency because this is a market that has been growing sporadically since 2007. And we've been seeing so much FX transactions in this market. Not only that, most emerging market currency have high importation, they import and export highly, most especially in oil. So we see a lot of FX transactions occurring with emerging market currencies. Furthermore, I would like to also mention that the currencies that I'm actually going to be using are the AED, which is the Saudi Arabia dirham. I'm using the CLP, which is Chilean peso. I also analyzed the Chinese yuan. I looked at the Korean won. I looked at the Mexican peso. I looked at the Malaysian ringgit, the Qatar rial, Russian ruble, South African rand, Turkish lira, Singapore dollar, the Saudi Arabia, Saudi rial, and the Thai baht. Now, from the earlier discussion, we have noticed in previous studies that there has been a negative relationship between the US dollar and the cross currency, both in domestic economy, both in the developed economy and in emerging market economies. So I try to document that graphically, and as you can see, we can see that from my graph, as the US dollar strengthens, we see a negative reaction to the main cross currency, meaning it widens with every increase or every strengthening of the US dollar. Also, as I explained earlier, I tried to document a triangular relationship between the oil price, the US dollar, and the cross-currency basis. And in most of the papers I read and most of the research and basic ideology, we come to an understanding that the US dollar, a strengthening of the US dollar actually causes oil prices to decline, which actually affects the cross-currency basis swap reason. Now, as I said earlier on, the US dollar is more of the global currency used all over the world. And we have noticed that as every point when the US dollar strengthens, it affects other economies. Reason being that now for the oil is actually denominated, it's actually traded most of the time in US dollar. So when it strengthens, it means that there will be a rise in the prices of oil. And if there's a rise in prices of oil, what happens? Other economies might find it difficult to purchase this product. Finding it difficult to purchase this product leads to a decline in demand, which affects supply and subsequently prices. We also noticed that when this price is actually declined, what happens is that most of the economies or most of the institutions that actually make use of this US dollar, we're talking about sovereign wealth funds, we're talking about Apex Bank, once they notice that there is a decline in prices, affect the supply, the money they receive in USD, which could affect the supply in the swap markets. It is pertinent to note that, yes, the USD is a global currency, but in the spot market, you could actually get this currency mostly in the domestic market. However, when it comes to the swap market or the synthetic market, we basically get it majorly from non-US markets. So we see that agencies who actually supply this USD after getting it from oil proceeds find it difficult to actually supply this USD in the swap market when prices of oil increase, when the US dollar increases, which affects basically the demand and subsequently supply. This has been explained. So as I explained earlier, this is a graph that basically shows the triangular relationship between the USD oil prices and the cross-currency basis swap, such that an increase or a strengthening of the USD leads to a decline in oil prices, which actually leads to widening of the CIP. Basically, in this paper, I tried to check if the USD actually acts as a driver of CIP deviation in emerging markets. I also tried to understand if there's actually a pricing risk factor of the USD in the area of emerging markets, and if the dollar actually acts as a channel or a driver of the CIP deviations in emerging markets, including the triangular relationship that exists between all three. Various papers have been written, various research have been carried out to find other channels that could affect the USD. According to Do in 2017 and Avidage, they looked at balance sheet, bank balance sheet. They also looked at regulatory constraints that could affect the supply of the USD, which could lead to widening of the CCB. Other papers have also been carried out to check the relationship between oil price and the CIB. People like Ida, Kimura, and Sudo, Shama, and Tursme, and a number of others. Also, there were papers carried out to check the relationship between the oil price and USD. Chen and Chen, Yusuf and Widget, most of these papers found out that there is a negative relationship between oil price and the USD, such that a strength of, once the USD strengthens, prices of oil actually declines. So I'm going to talk next about the theoretical literature underpinning my work. Here I explained that the CIP condition actually holds when the interest rate in domestic currency is equal to the interest rate in the foreign currency after it has been hedged. Also, I use the Taylor's rule to linearize my model, and basically these are the figures I got. I tried to understand how the cross-currency basis has actually occurred in the 13 emerging markets that I'll be using. And as you can see from the graph below, both in the 5-year and the 10 years cross-currency basis, you will see that there is actually a violation of the CIP condition. It's actually supposed to be equal to 0 but because of the violation, we can see differing movements amongst all 13 countries. So basically, I took my paper, the data I used was basically from Bloomberg. I used the BDI, which represents the US, the US trading relationship with emerging markets. I also used the bilateral exchange rate between these currencies and the USD. I went further by checking the VIX, which implies the implied volatility using the S&P 500 index that shows basically the global risk sentiment concerning the US, concerning changes in the USD. I also took into consideration risk reversal, implied volatility using the apologies. Oh Lord, sorry. So I went further. I spoke about I used term spread. Here I looked at the spread between the foreign currency 10-year bond and the 2-year USD. I also looked at the yield spread, that's the difference between the 10-year bond in the foreign currencies and the 10-year bond for the USD. And finally, I looked at the Fed's policy rates, how the changes in the Fed's policy rate actually affects the CIP, the CIP conditions of emerging markets. So from my analysis, starting with the summary statistics, we can see that on average, 13 currencies actually show a negative relationship, which means that in the domestic market, which means that in the domestic market, it's actually lower to actually borrow from the spot markets, which is domestic currency, and arbitrage in the swap markets. In this kind of situation, arbitrageurs actually make more profits than the people whom they are lending to. Unlike other other countries which show this negative relationship, we can see that for the South African rand, it is those who actually lend from this domestic market are the ones who actually make more profit, not even the arbitrageurs, not even the owners of the USD themselves. Furthermore, I tried to explain the 5-year cross-currency analysis between the CIP deviation and my earlier stated my predictors. So we can notice that on average, when all predictors are being accounted for, there is a negative relationship between the BDI and the CIP and the cross-currency basis, such that a unit increase in the BDI leads to about a 1.229 decline in CIP deviation. I also found out using the 10-year cross-currency basis that this actually holds. A unit increase in BDI would lead to a 0.439 basis decline in the CCB. Moving on, I tried to analyze the relationship between the 5-year cross-currency basis and the USD. So from my analysis, from my graph, you can see that as the USD increases, there is a widening of the mean cross-currency basis such that it actually declines with every strengthening of the USD. This was also found in the 10-year analysis. I tried to also look at the pricing risk factor of the USD amongst emerging markets. So in my analysis, I realized that, in fact, the USD is actually, so most of the time, the arbitrageurs actually ask for higher premium in this case, which continues to widen the cross-currency basis even more. It makes it even more negative than it should have been without it being priced in, as can be seen in my analysis. From my analysis, I realized that with every increase in my dollar beta, the mean cross-currency basis actually increases. And from various studies and various understanding, this actually shows that the dollar acts as a pricing risk factor to the in the FX transactions. So as I mentioned earlier, I was also going to be looking at the triangular relationship that exists between the USD, oil price, and the CCB. From my analysis, I found out that with every increase in oil price, the CCB actually increases in the same stem. With every increase in the USD or very strengthening of the US dollar, the oil price actually reduces. So I created the graphical representation of such. So majorly, to fully explain what has been happening, it is majorly this. When the USD strengthens, there is a decline in foreign countries' economic activities because the price of oil has now increased. And most of the time, oil is used for so much economics, so much, it's basically used in most of the services, a lot of production, most of this depends on the oil. So when it increases, what we basically see is that less and less people actually demand for this oil because they cannot meet up to it. And even if they decide to purchase it, it actually causes an increase in production, an increase in prices of goods and services, and the likes. Next. Sorry about that. An increase in price of goods and services and the likes. And what happens? Because there is less demand for them, it actually affects the supply. And because they want to try it as much as possible to now people purchase this good, purchase this commodity, we see oil prices decline. And when oil prices decline, we see a widening of the cross-currency basis swap. So I went further by giving a model concerning my entire analysis. So what happened here is this. Suppose that we have a representative, an agent, related bonds from the dollar market. What happens majorly is that he will try as much as possible to hedge will try as much as possible to hedge his currency, the FX risks in the swap market to the domestic market. So in this situation, I tried to explain that the agent's lifetime liquidity function is basically constrained to his use of funds and his inflow of funds. So in the use of fund, I explained his funds are basically used up by consumption, and the PTG of goods and services he actually used in purchasing these goods. BT represents the new bonds he would want to purchase in the future. AT basically presents the oil inventory he would like to have in the future. And the price of this oil is presented as PT, and the spot market for the oil is presented as ST. I also explained the inflow of this oil, basically the inflow of his income. Basically, it comes from the fact that this particular representative agent already has oil inventories in the past, in the previous year, which is presented by 80-1. And the price of such oil inventories is represented as PT oil. And the spot market of purchasing this oil inventories is basically ST. I also mentioned earlier that this emerging market agent, it actually purchases dollar-denominated bonds and decides that when he purchases this bond, he has to hedge it in the swap market. And also from this bond, he earns interest basically on the bond. So all of this is represented by 1 plus IUSD multiplied by BT-1 over ST-1 times FT. Also, I make mention that the agent in this case actually has YT, which is his income from the labor he actually does. So majorly in my analysis, I try to explain that when an agent decides to make optimal decisions, his interparallel marginal rate of substitution increases when future oil prices are higher and future dollar exchange rate is stronger, and decreases when the future goods prices are higher. Majorly, what do we explain by interparallel marginal rate of substitution? This is basically the rate at which a person will trade present consumption for a small increase in future consumption. What I'm trying to say is, if the agent actually knows that in future there might be an increase in prices or so, he might try to forgo some of his current consumption and look into consuming those goods in the future. So using most of the Taylor's analysis and using the Lagrangian function, I try to explain that in a situation where the agent makes optimal decision, we have the price of the goods and services divided by the price in the future will equal to 1 over the inflation rate, which is represented by 1 plus pi t plus 1. I'll take that again. Apologies about that. So basically, I try to explain that when agents make optimal decisions, you will see that their consumption today divided by the consumption in the future will be equal to the 1 plus rho today divided by 1 plus lambda in the future over 1 plus inflation rate, 1 plus pi in the future, where 1 plus rho today is actually, where 1 plus rho today times the 1 plus lambda in the future is actually equal to the nominal gain or profits of in the emerging market currency when he purchases crude oil purchasing crude oil today against purchasing crude oil in the future. Then I also explain the inflation rate, which is 1 plus pi, which explains that if he knows that there is an increase in the future, he might actually want to leave consumption today and purchase in the future. I also have a second proposition that explains to us that in a situation where the agent is actually optimal, we will see that the CIP condition would actually hold, whereby his consumption today will be equal to the real gross interest rate in the future. And finally, in a situation where this condition doesn't hold, such that there's a breakdown in CIP condition, I also explained it in the graph, in the analysis, as we can see. So majorly, from all of my analysis, I realized that the BDI, which is the broad dollar index, actually impacts the CIP deviation of emerging market currencies, such that a strengthening of the USD equals to a widening or a decline in the cross-currency basis swap. Also, I realized in my analysis that oil prices has a positive relationship with the cross-currency basis swap, such that an increase in oil prices or a decline in oil prices leads to a tightening of the CIP condition or a decline in the CIP condition. For following my analysis, I realized that there was actually a triangular relationship that happens among these three variables, such that when the US dollar actually increases, the oil prices actually drop, which causes the CIP condition to widen. I therefore give out future research ideas that could be used. First off, since I looked at majorly the emerging market, and there's a lot of papers concerning the developed markets. I think there should be other papers we're looking into the new frontier economies. Secondly, as mentioned earlier, different research papers have given out their various channels as to the cause of CIP deviation. So I think other papers should actually look into exploring this relationship and seeing which actually holds a higher implication for the CIP deviation. And finally, implications of all the channels that have been discussed earlier as to how it affects real money managers who gets money through the spot market and try to hedge it in the synthetic markets. Thank you very much.
Thank you very much, Chika. Thanks. Yes, so any questions? Before any questions are asked, I just wanted to comment on the last point you made about looking at this exercise in new frontier economies. What do you mean by new frontier economies? What economies are these? Are these different from the ones that you have considered? And if yes, what are they? Hello?
Okay.
Yes,
Yeah,
what
sorry,
are
I'm
these
here.
new
I'm
frontier
with you.
economies?
So basically, new frontier economies are different from the emerging market, which I've actually considered. Emerging markets are markets that, from various analysis, they are markets that are trying so hard to, in layman terms, to reach the level of developed markets. For the new frontier economies, they're more or less like developing markets. They haven't even gotten close to where the emerging markets have gotten to. So we're looking at places like Nigeria, most of the time being considered as a new frontier economy. We're looking at growing, most times they're actually in African markets. We're looking at places like Ghana. We're looking at places like sorry, just a moment. Okay, so we're looking at places like Nigeria, Ghana, some places in Latin America. We're looking at various economies that are still in the developing states, not just the emerging markets.
The problem with those types of economies, and that's why we haven't seen a lot of research on them, is that they don't have a liquid swap market. For example, in Africa, it's only South Africa, to the best of my knowledge, that has a very liquid currency swap market. And that's why you see that they have data for cross-currency basis, because there are people on both sides, counterparties, who are willing to do this trade in South Africa versus, say, the US dollar versus, say, the euro. Or the challenge you are going to face if you're trying to analyze frontier markets is that, you might not be able to get data on them. Okay, you might not be able to get data on them. That's the only challenge, but that's good. Okay, so Okwayo Komi has a question. Please, you can go ahead and ask the question.
Thank you for the presentation, Odinaka. Can you go back to your model? I want to call your attention to something there. All right. Yeah. Is there any reason why there is no expectation in this your objective function?
A reason why there's no expectation in objective function. Basically there were expectations, but I didn't want to write the entire thing out. I just put it out.
Okay.
And
Let me comment on
using
that.
the Taylor's rule.
Yes, that's good. Let me comment on that. Or maybe we can, Salako can comment on that, right? Salako, would you like to comment on that? In addition to what Chika Odinaka has said, you want to comment on that? Because yes, this is correct. So where you come in, notice that this model doesn't have anything like expectation. And then the previous one, which you presented, has expectation. So Chika Odinaka has just explained why the expectation is missing. Would you like to add something to that?
So mine is stochastic, and this I think is deterministic. So
okay.
Yeah.
I see. Okay, yeah. So in addition to what Chika Odinaka has just said, yeah, what Salako said is very important. So this model, Chika Odinaka's model, is a very deterministic model. Okay, and so because it is deterministic, you see the amount of mathematical computation needed is high, but it is still more doable, and it is still within limits compared to when you have a stochastic case, when you do not have a perfect foresight, where you now have to introduce a lot of approximation theory. So the difference between this model, there are many differences, but they have the same objective function, meaning that they are maximizing the present value of the lifetime utility. The difference between both of the objective functions is that one of them is deterministic, which is Chika Odinaka's case, and Salako's zone is stochastic. And that's why you keep seeing expectation. And that's why you saw that Salako introduced the Taylor theory that is based on expectations to do some approximations and all of those solving. Okay, does this answer your question?
Yes, sir. I know this is deterministic, but I'm just trying to ask about the how realistic that is, because you're talking about
yes, so yeah, very correct.
You're talking about the lifespan of
the
household.
So this is a good point. How realistic? It is not as realistic as the stochastic case, because in reality, things are stochastic in life. However, this is a way to simplify reality and capture the relationships that are being studied based on this simplistic version. A more rigorous and extensive way is to look at things in a stochastic framework, in which case it will be more complicated. So you're correct that it may not capture reality in full force. Even the stochastic case does not fully capture reality, but it captures reality more than this case, which is deterministic. Because in the deterministic case, you are making a strong assumption that the agent has a perfect foresight.
Yes, there's a perfect foresight, yeah.
Exactly, which we all know that in real life, it is not so. However, a deterministic case can give you a simplified version of reality, which you can now use to study whatever problem that you want to study, but you have to note the limitation.
All right, thank you, sir.
Clear? Okay.
Yeah, thank you. Thank you.
Okay. Yes. Any other questions for Chika?
Yeah, one question. Sorry.
Okay.
So could you go to the descriptive the graph for the 5-year currency basis? Yeah, so this to the 10-year and the 5-year. So I understand that, of course, when the dollar strengthens, then the currency basis deviates more. But there seems to be a sharp negation of this idea around this 2022, and the same thing in the 5-year currency basis. Was there an attempt to explore why this was the case in the paper? Just an explanation of why this could have happened.
So it was not actually explored in the paper, but what I will think is majorly as a result of looking from 2020 to this present, the effect of the COVID-19 on the financial markets. So we saw a lot of distortions following that. So that's basically where my mind is shifting towards, but I didn't have enough time to actually explore it in this paper.
Okay, thank you.
Another comment I wanted to make concerns the magnitude, the size of the deviation. I noticed that, can you go to the mean basis and the standard deviation? Can you go there again? The summary statistics that you did, the summary statistics. Yeah. Okay, these are very huge deviations. I mean, in the Salako, what was your own deviation, mean deviation for your Euro USD basis?
I think the
Were they
highest,
up to like 50, minus 57, minus 81 and all of that? Were they up to that? No.
so the highest for 1 year was around 120.
120.
Pretty high.
Okay, what about the average? We're talking about the average.
Oh, the average. Okay, so I saw like the lowest I see here is like minus 13. So that was like,
you see, minus 13 compared to, we are seeing minus 76, minus 87. So Chika, can you tell us between what Salako looked at, which is the more developed market, the Euro area or the Japanese yen or any of these other developed markets, compared to the emerging markets? If I have dollars in hand today, can you tell me which of the CIP trades will make more sense for me to do and why?
Okay, so if you have more dollar today, it will be better for you to use the CIP trade in the emerging markets, because the more negative you see your mean, according to this summary statistic, the more profits you'll be making. And we know that the emerging market is still more or less like an upcoming market, a lot of resources to actually tap into. So it will be better in emerging markets.
Okay, that's great. But why do you think that people should be seeing this? I mean, money managers in the US, around the world, who have access to the US dollars, they should be seeing this and taking the money to this market and making huge profits. Why are they not doing that? Like, take for example, you see that of the Korean won, it's about an average of 87. Okay, we are doing that in my practice. That is an attractive market for us. We make a lot of money from there. But why is it still like that? Why are more people not going into this and arbitraging all of those profits away?
Okay, irrespective of the fact that, yes, you make more profit in this market, it's still a very risky market. And the common man is more or less trying to be cautious. He wants to play in a more cautious space. You could actually run into this market and lose all of your profits, and also lose your principal in it. So we see more persons trending towards the developed market than towards the emerging markets, just because of the risk involved in it.
I see, and that's why we still have
in the Euro bonds market and the rest.
Okay, that's great. Thank you. Any other questions, please, for our last speaker, Chika Odinaka? Any other questions for her, please? Any other questions before we call it a day? Any other questions?
Hey.
Yes.
Yeah, thanks for the presentation. A really nice one there. But something caught me across when you're talking towards the end. You keep mentioning about CIP conditions, right? What are those conditions you base your research on for this particular paper you're trying to explain to each and every one of us?
Okay, so the CIP conditions basically states that the difference between the swap and the spot market should be equal to that between the interest rate of the two currencies actually involved in the FX transactions. So I just want further clarity on what you mean by other conditions I based my research on.
Okay, perfect. Thank you for the clarification. I appreciate that, man.
All right, thank you.
Any other questions before we call it a day? Any other last questions for Chika? Actually, we have two Chikas here. We have Professor Chika and the much younger Chika, up and coming researcher. All right, if there are no other questions, I wanted to thank everybody, especially the participants and the speakers, for participating and for speaking. This session has been very high quality to me. At some point, it sounded as if I was listening to established researchers in development economics or in asset pricing or in international finance, financial economics. So I want to thank you all for participating. And I realize that we have gone beyond the time limit that we wanted to use. So I'm sorry for us extending the time, although we started late, but I think we have extended the time more than when we started. So I thank you all for participating. I thank you to our speakers, Salako, Bukra, Muhades, and Chika Odinaka for the excellent presentation. They were nice, and I hope that you have gotten a lot of comments that will help you improve your papers and make you well ready for the interviews that you'll be having with the universities that you will start speaking to starting from February. I believe that you guys are going to do well because you are well practiced, well rehearsed, and whatever questions they ask you, just ensure that you give them the answer and you don't doubt what you have said, because if you doubt what you have said, they would want to push further. But maybe they don't have the details of the answers themselves. So if you give them your best answer, just stick by it. And if they ask you further questions, try to speak around the answer that you have given. So thank you to everybody for participating. We do appreciate it. We'll be doing this every year. Hopefully next year, this time, we will have some other high quality mentees. The people we call mentees are the people who have succeeded in our courses, and then they have done the research. Either they have succeeded in the courses or they've done the research, and we now bring them on board because we want to support their applications. So those are the legitimate mentees. So we are hoping that by this time next year, we will have like 5 or 10 mentees whose applications we will have supported and who will be presenting their research to all of us this time next year. So thank you, everybody, and have a nice day.
Thank you.
Thank you.
Thank you.
Thank you. Bye.
Thank you.
Thanks, Wally.